Hello, everybody. This is Alex Fensky, the lead agent for the Chicago Southland Homes team here at Keller Williams Elite, and I'm excited to bring you the January 2023 housing market update. We're going to take a look at December's numbers and talk about what they mean for you and for the marketplace. We'll do what we can to predict the future, but today I'm going to go into a different concept than the typical topics. Because I think it's necessary to explain what's happening in the marketplace, which otherwise looks really confusing. Now, quick disclaimer, my data is for the Northeastern Illinois coverage area for Midwest Real Estate Data, LLC. My data sources are Midwest Real Estate Data, LLC, the St. Louis Fed, and MortgageNewsDaily.com. In this case, for the Housing Affordability Index, my source is the National Association of Realtors, which is the entity that publishes this data. So with that, let's dig in. Number one, the reason that you're hearing that the real estate market is changing, that demand is less, that all this stuff, you're hearing about mortgage rates, yes, you're also hearing about prices. Overall, the reason is what's called the Housing Affordability Index. And what that is a measurement of three different things. It's number one, household income, how much money people are making, because that changes over time. Number two, home prices. And number three, mortgage costs. So if you think about it, if home prices go up a lot, but so does household income, then affordability stays about the same. If prices go up a lot and incomes go up a lot and mortgage rates go down, then affordability gets better. If mortgage rates go up, then it depends on how much. If prices and mortgage rates go up and household income stays flat, affordability really takes a dig. So this is a complicated thing, and I'm glad I don't have to do the data, but I get to benefit from the data. Thank you very much, NAR. So long story short, what's happening is the Housing Affordability Index has really taken a battering through this market shift because of all three of those things. Incomes have gone up, but not anywhere near the pace that home prices and mortgage rates have. And what's happened is that homes, as a result, become so expensive, so unaffordable, that people either can't buy, won't buy, or are not willing to give up what they currently have in order to buy whatever's coming next. So here is what the Housing Affordability Index is. It's an index, so it's based on 100. And a 100 Housing Affordability Index means that the median household income earner with 25% of their income could pay the principal and interest on a 30-year fixed rate mortgage at the current rate on a median priced home. So median income, median priced home, 30-year fixed rate mortgage. They could pay principal and interest with 25% of their income. That's if that were all true, the index would be 100. And there have been plenty of times where it's been just about that. If the index is higher than 100, then it means housing is more affordable. That means that they wouldn't have to spend 25% of their income to get a mortgage on a median priced home. It would be less. If the index is below 100, it means that homes are less affordable than that. And in order to get a median priced home with a median mortgage rate, I would have to use more than 25% of the median income earner's income. So hopefully that all makes sense. And here's what it looks like today. Nationwide, 1 year ago in October 21, my most recent numbers here on October 22. So 1 year ago in October 21, nationwide, the housing index was at 148. That's pretty darn affordable. It's well above 100. It was down a bit because if you go all the way back to 2019, it was 160. And in 2020, it went down a little, but not a lot because housing prices went up a lot. But in 2020, so did household income. If you remember all the stuff that happened in 2020, 21 it dropped to 148. But by October of 22, it had fallen all the way from 148 to 91. So not only did it fall a tremendous amount, it also crossed over that threshold of 100 and went below that, which means affordability has gone really far down. It's interesting to note that there's 4 primary regions of the country that they break this data up into. They break it up into the Northeast, the South, the West, and the good old-fashioned Midwest. And the numbers are very different. They all fell by about the same amount, by about 37 to 38% over the last year, which is a huge change. They all fell from about the same amount, but they started in different places and they landed in different places. In the West right now, their index is all the way down at 63. The other two regions are in the 90s. The Midwest is at 124. What that means is that the Midwest is the only place in the country right now where the median income earner can buy a median priced home with a quarter of their income. You can't even get close in the West, and you're close but not quite there in the Northeast and the South. Now, those are still huge regions, and there's still areas within those where the index would be way higher or way lower than that. But taken as a whole, the Midwest has not seen housing affordability get as out of control as it has in the other places. So when you think about pricing and what's happening with pricing, this explains it. What doesn't explain it is our typical market data. And that's why I wanted to introduce this. So hopefully that makes sense. If it doesn't, just comment with a question or something like that. I'll be sure to answer it. But now we'll roll into our typical metrics that we look at, starting with supply. Supply is down significantly. And I know that may sound strange to you because of what you're hearing, but the media tends to focus on demand and if demand is up or down, but it's only half the equation. It matters what happens on the other side of the equation too. Supply is down significantly. New listings are down 24% compared to last December. It's the fewest new listings in any December that I've got data for. There's 10% fewer homes on the market compared to last December. The second lowest month on record, not just second lowest December, the second lowest month on record, beat out only by February of 2022. So there are darn near record low homes for sale right now. It's a good thing there are because demand fell off by just the same amount. Pending contracts and closed sales are also down significantly compared to last year. Pendings are down about 29%. Closed sales are down 37%. Those figures both are the lowest December demand all the way back to 2011. So we have huge drops on both the supply and the demand sides. And the resulting relationship between supply and demand is that we still remain in a relatively stable seller's market. There's only 1.5 months of housing supply. It was 1.4 last December. It's about the same. There's still far more buyers than there are sellers. That's the point. Typically, when there's way more buyers than there are sellers, you see prices go up. When there's 1.5 months of supply, I should be seeing significant price increases, but we're not. In fact, we're seeing prices be flat to slightly down. December was the second month in a row for the first time in a long time that pricing this month was actually down a little bit from the same month last year. December prices were down 2.2%. In November, they were down for the first time in a long time. So that's 2 months in a row that our monthly pricing was below last year's monthly pricing. I can't explain that with a 1.5 month supply market. The only thing that explains that is housing affordability. People are still having to compete for homes. They're still selling quickly. Median days to contract, 16 in December. That's half what it was in December 2019. And a 12-month rolling average for median days on market has been at 9 days flat since September 2021. It's been almost a year and a half. The median days on market hasn't changed. So how do you explain that there's competition for scarce listings, but prices are flat to down? It's because of housing affordability and people are having to compete for homes in other ways besides bidding up the price. They're no longer bidding up the price. So you can compete on closing time frame, financing type, amount of your down payment, earnest money amount, buying as is, seller possession. And there's all sorts of stuff that you can do to compete for a home as a buyer that are not price. And that's what people are relying upon because that extra 10 grand is costing them much more than it ever has in recent history. Let's touch on mortgage rates for a moment. Mortgage rates are going to continue to be volatile. They're going to continue to be all over the place. Right now, today, January 5th, 23, the 30-year fixed rate mortgage is clocking in at 6.41%. It's up about a half point from recent lows, which were in mid-December, but it's still a point lower than rates were at like end of October, early November. They were well into the sevens. So continued volatility. The Fed is going to keep raising their target rate. They're expected to raise it by 25 basis points in February. And importantly, at the last Fed meeting, exactly zero of the Federal Reserve chairmen expected that they would execute any rate decreases in 2023. Zero of them. They all said, no, there's not going to be any decreases. They're going to slow down the rate of increase, but they're not planning on any decreases. Anytime there's going to be announcements like that, though, expect volatility in mortgage rates. At the end of the day, other than contacting us to find out what you should do about your personal circumstances, what can I tell you? Well, I can tell you that short market times and ample, even strong demand are very real, but they will not show up for you in price. Sellers should know that. You're still going to have to compete to get the buyer because pricing is the battle right now. There's a lot of buyers, but you have to do battle on pricing. And on the buyer's side, your number one enemy or your number one opportunity, depending on how you look at it right now, is mortgage rates because they're volatile. You could get a rate, today's rate from your mortgage company, then you could lock this afternoon, and the rate may be different in the afternoon than it was in the morning. So pay attention, work with a great lender like the ones that we recommend, and know when the big announcements are coming so that you can have a little bit more certainty around whether you are locking or not locking, or whether you're waiting or floating or whatever the case may be. And so reach out to us for customized and tailored information for your needs. Even Northeastern Illinois contains so many different micro markets. You can't base decisions on the generalities that I've given you here. This is better than the national news, but it's not hyper-local, and that's what you need when it comes to real estate. So drop a comment, send a message, whatever format you're watching this on, somehow reach out to us. Phone number at the office is 708-808-0220. That's 708-808-0220. Or you can visit us on Facebook, Chicago Southland Homes. I look forward to hearing from you, and Happy New Year.